The stock market has made more millionaires than any system in history, yet most investors still lose money. That contradiction isn't accidental. It's the first warning sign that something deeper is at work. Most people enter the market believing success depends on intelligence, insider knowledge, or picking the right stock. But the market doesn't reward intelligence alone. It rewards emotional control, and that's where most investors fail. Every rise creates confidence. Every drop creates fear. Red numbers trigger stress, headlines amplify panic, and suddenly long-term plans feel dangerous. What starts as a temporary decline feels like a permanent threat. Decisions made in fear feel protective in the moment, yet quietly lock in losses that patience would have erased. The market doesn't steal your money overnight. If investing has ever felt harder than it should, you're not imagining it. The stock market is not just a financial system, it's a psychological test. And until you understand how fear, greed, and pain influence your decisions, the market will continue doing what it does best, transferring money from the emotional to the disciplined. Let's watch. 1. Emotional decision-making overrides logic. The single biggest reason investors lose money is emotion. Fear and greed overpower logic far more often than analysis or strategy. When markets rise, optimism turns into euphoria. Investors rush in because prices are going up, not because the investment makes sense. Valuations stop mattering. Risk feels invisible. Buying feels safe because everyone else is doing it. When markets fall, fear takes control. Losses feel unbearable, even if they're temporary. Investors stop thinking in percentages and start thinking in pain. Markets are designed to exploit emotional reactions. Many investors abandon solid plans at the worst moments, locking in losses that patience would have avoided. Successful investing requires emotional discipline, doing the boring, uncomfortable thing while others panic. Most people simply cannot do that consistently. 2. Trying to time the market. Many investors believe they can predict when the market will rise or fall. They wait for the perfect time to buy and try to exit just before a crash. Even professional fund managers fail at this most of the time. The problem with market timing isn't just that it's difficult, it's that it's emotionally exhausting. Each decision increases stress, doubt, and second-guessing. Research consistently shows that missing just a handful of the market's best days can devastate long-term returns. Those best days often occur during periods of extreme fear, immediately after sharp declines, exactly when most investors are sitting in cash. The truth is simple but uncomfortable. Time in the market beats timing the market. Investors who stay invested through volatility generally outperform those who jump in and out, even if their entry timing isn't perfect. 3. Lack of a clear strategy or plan. Many investors enter the market without a real strategy. They buy stocks based on tips, headlines, social media hype, or recent performance. Without a plan, every price movement feels like an emergency. A solid investment strategy answers basic questions. Why am I buying this asset? How long will I hold it? How much risk can I tolerate? Under what conditions will I sell? Without clear answers, investors react emotionally instead of acting strategically. News headlines trigger impulsive trades. Market dips cause panic. Rallies create overconfidence. When losses occur, and they always do, investors without a plan are shocked. They never anticipated volatility, so they assume something is wrong. Panic replaces patience, and mistakes multiply. A written strategy provides structure during chaos. Without it, emotions dominate, and the market punishes improvisation relentlessly. 4. Overconfidence in the illusion of skill. Most investors believe they are above average. This overconfidence leads to excessive trading, oversized positions, and unnecessary risk. When risky bets work, investors credit skill. When they fail, they blame bad luck. This false feedback loop reinforces poor behavior. A few lucky wins convince investors they've figured it out, encouraging them to take even bigger risks. Studies consistently show that frequent traders underperform the market. The reasons are simple: poor timing, emotional decision-making, transaction fees, and taxes. The more investors trade, the more opportunities they create to make mistakes. Markets are humbling. Even the smartest investors make errors. Those who succeed respect uncertainty and manage risk. Those who believe they've mastered the market are usually the first to be punished by it. 5. Chasing hot stocks and trends. By the time an investment becomes popular, much of the profit has already been made. Most investors chase trends because excitement feels safer than patience. Media hype, social proof, and fear of missing out push people into overvalued assets. This pattern repeats across history.com stocks, housing bubbles, meme stocks, cryptomanias, and speculative tech booms. Early participants may profit, but the majority arrives late, buying inflated prices driven by unrealistic expectations. When reality catches up, prices collapse, and latecomers suffer the largest losses. Chasing performance is a proven wealth destroyer. Markets reward discipline, patience, and independent thinking, not excitement. The best opportunities often look boring, uncertain, or uncomfortable when they appear. 6. Poor risk management and lack of diversification. Many investors make the critical mistake of concentrating too much money in a single stock, sector, or idea. At first, this feels powerful. Every gain is magnified, and confidence grows rapidly. But concentration is a double-edged sword. One unexpected earnings miss, regulatory change, or industry disruption can wipe out years of progress in a single moment. That's why diversification isn't about maximizing returns. It's about surviving mistakes. Another common error is misunderstanding true risk tolerance. Investors often think they can handle volatility until the market actually tests them. When portfolios drop 30 to 50%, fear and panic take over, and rational decision-making disappears. This is when panic selling occurs, locking in permanent losses. The stock market doesn't demand perfection, it demands survival. Investors who ignore risk management or concentrate too heavily often endure losses so severe that they never recover. Discipline, diversification, and emotional resilience are what separate those who thrive from those who fail. 7. Unrealistic expectations and short-term thinking. Many investors expect fast results, believing that quick gains are the key to success. When profits don't materialize immediately, frustration sets in, leading them to abandon carefully chosen strategies, sell winning positions too early, or chase the latest hot investment idea. This impatience undermines one of the most powerful forces in investing: compounding. The stock market builds wealth slowly, then suddenly, and attempting to accelerate the process often destroys its potential. Real growth requires time, consistency, and patience, yet most investors treat it like a sprint instead of a marathon. Short-term thinking magnifies losses, as daily price fluctuations feel urgent and meaningful, even though they are largely irrelevant to long-term outcomes. Investors who adopt a multi-year perspective, focusing on trends rather than daily swings, dramatically improve their chances of success. Patience, endurance, and a long-term mindset are the true differentiators between those who build lasting wealth and those who constantly chase fleeting results. Most investors don't fail because they lack information. Every crash, every rally, every headline is a test of emotional control. And most people fail that test not once, but repeatedly. Pain convinces them that short-term relief is more important than long-term wealth. None of these decisions feel foolish in the moment. They feel necessary. That's why the market keeps winning. They stay invested when fear is loud. They stay patient when progress is slow. They follow their plan when emotions beg them to abandon it. In the end, the stock market is less about predicting the future and more about surviving yourself. Volatility will always exist. Crashes will always come. Uncertainty will never disappear. But if you can master your reactions, if you can sit with discomfort while others panic, the market stops being a threat and starts becoming a tool. Because the greatest edge in investing doesn't know what will happen next. It knows how you'll behave when it does. Let us know in the comments what you think about why most investors lose money in the stock market, and don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.